I'm Bryan from Money Markets TV. Last November, the Fed officially announced its plans for a second round of quantitative easing, better known as QE2. This was a step most experts thought would destroy the dollar. Despite the bear mania surrounding the dollar at the time, I saw it differently, especially given what happened after the Fed's first adventure with QE. My conclusion, a collapse of the dollar just wasn't in the cards. So 3 days after the Fed announcement, I showed you several charts here in Money and Markets that made the case for the buck. And so far, I've been proven right. In fact, the dollar is higher now against the benchmark basket of currencies than it was before QE2. Today, as we reach the halfway point of the Fed's bond buying program, I'd like to revisit those charts from November and look back at how my analysis played out. Chart number 1 shows the dollar's performance over the past 40 years since the failure of the Bretton Woods system. Back in November, I pointed out that this long-term analysis indicates that the dollar moves in 7-year cycles roughly. That means that the current bull cycle started in March of 2008, just 3 years ago. And it also means that this leg up for the dollar still has a long way to go. In fact, the dollar bottomed a day after the Fed's formal announcement on QE2 and rose nearly 8% in the following weeks. Despite some recent weakness, it's still more than 1% stronger than it was last November, and it remains in a multi-year bull cycle. The second chart shows the 7-year downtrend in the dollar that ended in 2008 and the upward sloping channel since. I said back in November that the dollar was testing the bottom line of this new bull channel, and the same remains true today. This represents an attractive, low-risk opportunity to buy the dollar here. The third chart shows the performance of the euro during the same period. It's essentially the inverse of the dollar during the last decade. A multi-year trend upward, followed by a descending channel since 2008. The Fed's QE2 announcement in November sent the euro sharply lower against the dollar, bringing the European sovereign debt crisis well back into focus. Since then, the euro's gotten a nice bounce, but the multi-year downtrend is still intact, and I think it could drop to parity against the dollar, perhaps as early as this year. Now, the British pound followed a similar pattern as the euro, turning over right around the time the Fed announced QE2 and falling sharply in the following months. And despite all of the fuss over a weak dollar, it still hovers around the levels it was trading back when the Fed announced QE2. Moreover, the pound remains 23% off of its 2007 highs, and it's still entrenched in a long-term downtrend. For the world's other major currency, the Japanese yen, I looked at its relationship to the US dollar going back 40 years. On that timeline, the yen's steady decline is clear. Back in November, around the time QE2, the dollar-yen exchange rate was near an all-time low. Since then, the dollar's gained 5% against the yen and continues to hold a stronger position. One of the main effects of the Fed's quantitative easing on the currency markets was that Asian countries and other emerging markets began fighting to keep their currencies from surging. They intervened in the markets and instituted capital controls because the dollar was declining, but also because the Chinese yuan was weakening as well because of its relationship with the dollar. That put those emerging economies at a competitive disadvantage for their export trade. In the 4 months since then, many of these countries have continued aggressive action to limit strength in their currencies. Meanwhile, the Chinese have continued to show resistance to any meaningful appreciation in their currency. And that's a dynamic I expect will continue, despite all the expert predictions of a big one-off revaluation in the yuan to come. So to sum it up, the Fed's decision in November to embark on another round of quantitative easing caused most analysts to predict a doomsday scenario for the dollar, but it hasn't played out that way. As I said back then, a grossly weaker dollar is not an economically or politically acceptable proposition for the rest of the world. So despite all the projections of a continued rout in the dollar, these charts suggest the exact opposite outcome could be around the corner today. And I stand by that forecast for continued strength in the dollar. I'm Bryan from Money Markets TV. Thanks for watching.